production in the United States is creating both jobs and investment opportunities. The CEO of Intervale Capital joins us next to talk growth opportunities in oil and gas. Squawk Box will be right back.
So is now the time to capitalize on the booming U.S. fracking revolution? The energy sector has created both investment and job opportunities. Intervale Capital is a private equity firm that invests exclusively in oil field manufacturing and service companies. Joining us right now is Charles Cherington, the co-founder and managing partner of Intervale Capital. And Charles, thanks for being with us.
Thanks for having me.
So you recently launched your third fund. It was oversubscribed. The goal was for $400 million. You came in with about $500 million in investors wanting to get in on this?
That's correct. And this is a strategy that really requires a small fund size by private equity standards. So $500 million is about all we could take. There was demand for much more.
Why does it require a smaller fund?
Unlike other sort of sectors in the energy space like E&P, power, midstream that can scale up and require large amounts of capital, services is a space in which you're investing in small mom-and-pop companies typically with high growth and putting great managers in from the larger service companies to help them kind of achieve their next level of growth. And if you scale up and let's say you're trying to invest $1 billion or $2 billion into that space, you're competing against large private equity firms, strategic buyers, et cetera. It's become a very attractive space. So we like to buy the raw product, professionalize it, grow it, and then sort of sell to those buyers on the back end.
That sounds an awful lot like venture capital investing, maybe angel investing almost to an extent. Does this have a better track record?
It does. The returns are much higher at the lower end of the market, although I wouldn't characterize it as venture investing. You know, we're typically writing checks of $30 or $40 million initially for smaller companies, and then when we sell, we'd be looking to exit at prices for anywhere from $250 million to as much as $1 billion, depending on the growth of the company.
Charles, we've heard a lot about the promise, both in terms of jobs and in terms of investing opportunities that these new arenas, particularly in energy, can bring on. But you bring up the point that regulation definitely is the wild card in this. It's not just federal regulation, but also state regulation. Where do we stand on that front right now?
Yeah, and for us, regulation is actually a good thing. The more regulation there is, the more services are required to satisfy them. So you have a deep kind of mishmash of regulations coming from states, even municipalities in some cases are trying to get in on the action, and then obviously the federal government. So the regulations are targeting, treatment of water, their methane. There's a lot of methane concerns, that is sort of leaks with pipelines, leaks at the well site, road traffic. So you can imagine in a place like the Bakken Shale up in North Dakota where they don't have a lot of infrastructure, trucks are driving out with water for fracks, they're taking oil away because there aren't pipelines. So managing the sort of externalities that arise from all this new activity is a big deal.
Well, one of the things that concerns me is that there have been transportation accidents. Why don't they build a pipeline to transport all that oil that's coming out of rock in the Bakken?
Well, first of all, they are building pipelines, but there's a distinction between a sort of a trunk line, the superhighway that might bring the oil out of the play and to oil markets or refineries, and the gathering systems that are required. So if you think of sort of a major artery and then a lot of capillaries feeding into it, a lot of the transport is focused on the fact that the gathering systems just can't get built quickly enough because the pace of drilling is so feverish. So 5 years from now, there'll be much more pipeline capacity, much more dense gathering infrastructure. But in the meantime, truck traffic is sort of the bridge between those two situations.
At the beginning of the year, most people thought the price of oil would go down, partly because of U.S. production. But the price of oil is higher than it was at the beginning of the year, and I think it's going to go higher still because of demand from the developing world. Is higher oil prices good for this new fund of yours?
Higher oil prices are good to a point. If prices get too high, then it actually is a real brake on economic growth. But, it's very hard to predict what's going to happen with oil prices going forward. You have all of the sort of international wild cards, Iraq, Iran, Libya, et cetera, what happens with their production. And in the U.S., we have a pressing concern for the industry, which is the export ban on oil. So we are not allowed to export any crude out of the United States because of a law that was put in place in 1973 in response to the whole OPEC crisis. We are almost out of refining capacity for U.S. light sweet crude. That's the sort of principal oil that we bring out of the ground. I would say in the next 12 months, we're going to reach our saturation point on refining capacity, and it will have a major downward impact on prices. So the Obama administration is looking at the issue. There are mixed feelings in Congress about overturning the ban. If they don't, it could be a real shock for the industry in 2015.
All right, Charles, thank you very much. It's great talking to you today.
Thanks for the time.
When we come back, Bill Murray.